Is this the order we were supposed to come out in?
This is the order we're supposed to sit in.
Okay, good. I wanted to. We had a lot of discussion backstage about getting that right. So this is the M&A panel at an M&A conference. So no pressure. I'm going to start with a really easy question, but to make it more fun, I'm going to put a bit of a challenge in there, which is I'm going to ask each of you just to tell us where we are in the M&A cycle, but I will deduct $10 from the first person to use a baseball analogy.
No risk of that.
Anu, or maybe a cricket analogy. Anu, I'm going to start with you.
I think the cycles itself, if you look at business cycles and the nature of cycles, has changed over time. This cycle has been driven by different trends as opposed to the traditional trends that you look at, because usually what are the things that you say? You look at interest rates, you look at unemployment, you look at growth rate. So growth has been muted, unemployment continues to be pretty low, and productivity and the numbers that companies are printing continues to be good. If you look at the M&A market and compare it globally, number of deals, about 20% down. Volume-wise, North America is 10% down. Europe and Asia, 40% down. Overall, about 20% down, right? So it's a bit mixed. And it depends, and all these comparisons I gave is beginning of last year to this year. If you compare the second half of last year, it's actually pretty good. So it all depends on what is the framework, because last quarter, several people were ready to kind of say, we are at the end
of the
and
world.
the world is falling apart. And then, everybody had a good holiday for a change, and you came back, and in January, things are very different.
Some of us had good holidays. Those of us who were on holiday when Bristol Myers got announced, it was less good. But
Depends on whether you were working on it.
It depends on
whether
whether
you
you
had
were
it
working
all.
on it.
yeah, better for those of us who were on it rather than finding out.
I'm not ready to write it off as yet, but I do see the difference in regional trends, sector-wise, as well as the size of deals. There is a difference between this year and last year.
Mark?
Well, I generally agree, and not to be sort of a chartist, but if you look at the last two cyclical peaks in '08 and in sort of the 2000, 2001 timeframe, very steep sort of inclines followed by pretty steep declines, which you've looked at over the last 4 or 5 years. It's moved around a bit, but it's not that same pattern. And this is still, even though we're down about 20%, it's still the fourth fastest start ever, second fastest start since the crisis. So on that basis, look, there are a lot of headwinds. Obviously, we talked about the macroeconomic. You got fragmented politics in Europe, trade, but it doesn't at this point. I think it's too early to call this as a cyclical end.
Me? Okay. Because I'm not a banker, our perspective is a little different. We're always 6 months behind the bankers, and 3 months behind the lawyers. So for us, we're really busy. I mean, for us, it's the beginning of the year where they are talking about how it became very busy. And the other thing we're seeing is everything is incredibly complicated, which is good for my business, but it's not so, nothing is as straightforward. You put two companies together, there's cash, it's a premium, everything's done, it's going to get done. Everything's got hair.
Is that a function of the fact that we have many larger deals? I mean, one of the features this year has been a real slowdown in smaller deals, but actually an uptick for the kind of $20 billion plus deals.
I personally think it's a mix of the ability to close. So it's the government side of the CFIUS and regulatory side of it, FTC, DOJ, is complicated. Bigger deals are more complicated, but even the smaller deals that we've got have hair all over them. If it's not cash and you've got stock in it, it's going to be complicated no matter what.
Well, I guess I would say your question is a way to ask the question about what do we see in the economy going forward. And if you think about some of the panels you had yesterday, I think there's some real concern about a near-term downturn in the economy. And while Anu talked about a lot of the things that were quite positive, whether it's employment in the equity markets, the one thing she didn't mention is the inverted yield curve. And in fact, the debt markets tend to often be a better prognosticator for the overall health and direction of the economy than some of those other measures. So I guess I'm of the view that we are at risk of a downturn in the M&A market because we are at the risk of a downturn in the overall global economy. But we'll have to see. There's certainly going to be more volatility, I think, in the answer to that question that we've seen in the past.
But volatility at the moment doesn't seem to be an impediment to people at least going out and trying to do deals. The confidence is there, even if as Joele says, there's hair on a lot of these situations. They take longer to close. They may not close at all. Anu, is that something that you're still seeing, the sort of high levels of confidence in boardrooms, people actually wanting to go out and execute these complex transactions?
So confidence is decent. I wouldn't say it's the highest level, but it's pretty decent. And the volatility has double impact, right? Sometimes the volatility causes a seller to take pause and say, how should I think about my valuation? Because a lot of people had their stock prices are just 15% down in November and December. And so you think about the world a little differently. Last week was trying. But volatility generally is not good for M&A, generally. But having said that, despite the volatility over the last 6 months, I think the M&A markets have been more resilient than past historical times of volatility.
Sorry.
And the only other comment I was going to make is a lot more is domestic focused as opposed to cross-border. So on cross-border, I'd say the confidence level is a bit different. Domestic people have higher degree of confidence in going forward with something.
I think our statistics say that it's the lowest. These are the lowest cross-border percentages, for the first 5 months that we've ever seen. So down in the low 20s.
Wait, the last 5 months is the lowest percentage?
Just looking at the year-to-date statistics through May, it's the sort of the slowest percentage of cross-border transactions we've seen in our database. So it's clearly, sort of the issues, the more mercantile approach in the world has had an impact. I'd only add on that it's sort of, confidence is interesting because you can argue since $20 billion plus transactions, we got a record number for the start. You can argue it's a risk-on market that way, that for transactions that have been on a list, that are very high on a priority list, become actionable, people are still transacting. The flip side of it is I do a lot of TMT, and people are talking supply chains now, a protracted issue with China, and I think it's starting to seep into the confidence issue. So the real question is going to be, this market has been driven very, very strongly by the $20 billion plus stuff. The 1 to 5, which is kind of the sweet spot, is down about 30% in number of transactions. The real question will be if the big deals start to taper off and we don't get a pickup in sort of the sweet spot, then I think the second half of the year could be more problematic.
Or indeed if a few of them fail, because the big deals this year have obviously caught headlines and it's given the impression it's a very robust market, but they haven't closed yet. And there are big deals, I suppose, entail bigger risks. So you only need a couple of them to fail, and then all of a sudden we're in a very bad-looking M&A market.
Yeah, another way I think people have also dealt with the volatility is using more stock. If you look at all these big deals, I think about 70% or so of the total consideration mix is stock. So that gives people a bit more as to, okay, maybe they go up and down a bit, but I have some sense of relative valuation.
Yeah. Joele, I want to bring you in on the stock point because you often get involved in deals where the shareholders are making a racket, sometimes activists, sometimes just regular shareholders. Is that a trend you think is getting worse? And by that, I mean, is it something where you're seeing more deals either be scuppered because of that or indeed deals not happen because boards or management are worried about how the shareholder base will respond?
I always have thought that companies that know their shareholder base know how the shareholders are going to react. And if they're going to go into a deal, they know who's going to object and who isn't. And in my experience, I've sort of been, since I'm working on the ones that have the competitive nature to it, where both the shareholders and the activists have come in, I don't think the managements I'm working with are surprised. I think what's different is the volume and the willingness of the shareholders to go to the media and not just complain in the boardroom and then just vote. So there's many, in the last 2 years, I think there's been many more opportunities to go to ISS, to go to the media, in addition to talking in the boardroom. I think I haven't had a problem pretty much getting the deals done. We've had a lot of noise in the marketplace in a lot of our transactions, but all of them have gotten their votes and they've all gone through.
Wait, so you're saying what's changed is not the willingness of shareholders to protest, it's the willingness of them to protest through public forums?
Externally, yes. I think that's where you're seeing the difference, is that, the people, the Wellington during Bristol, you're seeing it go into the marketplace for whatever reason.
Well, what is the reason? Because if companies are getting better at knowing their shareholders, that would also suggest there's better dialogue.
There absolutely is a better dialogue. Everyone knows who's going to say what to whom most of the time. And I think there may be some very internal marketing situations that apply to the shareholders. You need a shareholder panel.
You know, and the only thing I'd say is that the business has changed a lot in the last 5 years. If you believe activism is mainstream, as I do, the rise of institutional activism in the last 10 years, as opposed to individuals. You know, what's really happened is we used to, at the point of announcement, the bankers could, and I'm going to be a little bit flip here, go away to the closing dinner. But now you got to monitor the shareholder base right through closing, through closing, from announcement to closing, because of the activist threat, because of event-driven hedge funds. And people are just taking the view, look, I got a view on this. I am the owner of the company, so why shouldn't I take a position? And if management's not responsive privately, then people will go public. It's completely changed the nature of what we do.
And finally, institutional shareholders are also asset managers, right? So when you see an activist asset manager who has a much smaller position and is in fewer companies have the type of impact they have, people who are giving money to the other asset managers say, you're in every company in corporate America, and you should have a voice as well.
Right.
So if you think about that as an asset management class with their own investors, it looks a bit more logical than compared to history.
Right. People want to see alpha where they haven't historically.
Exactly.
Stefan, on the question around sort of deal risk and things closing, and you know this relates back to shareholders because shareholders will come in often and say this is too risky, or you should go with a safer option. You have a fairly unique seat because you've obviously spent time both on Wall Street and in DC, in government. Do you think the advisory community, and I suppose by that I mean, you know, bankers, lawyers, PRs, people who are talking to the companies before deals, do you think they are familiar enough with what's going on in Washington to actually give that advice in some way? Because it does seem,
Right.
you know, and I don't want to single out deals, but it does seem like on some very big deals, and I apologize, Joele, Qualcomm being probably the most obvious, there has been some disconnect in terms of like what companies thought they should be worried about and what in reality unstuck the deal.
Well, having worn both hats, I was frankly very surprised by the lack of sophistication and knowledge that Wall Street and the business community generally has about what's going on in our government, and vice versa. I was equally as surprised about how little sophistication and knowledge senior government officials generally had about what was going on across the business landscape. And I think that's only gotten exacerbated, frankly, in the current environment, which has been dramatically more predictable and uncertain than anything we've seen in the past. And so how companies are going to navigate the tariff issue is not only new, but it's been unique to decision making. So this came up in your panels yesterday in virtually every single panel. And I would say that, you know, a year, 2, 3 years ago, it would not have even been mentioned once. And so when you think about deal making and taking large aggressive steps when there is a level of uncertainty and risk and knowledge that historically companies have not had to deal with, I think it adds a level of complexity.
Although if it's coming up in all our panels, that would suggest, I mean, they are primarily Wall Street people, that would suggest Wall Street maybe is getting a bit better at understanding.
Well, they're identifying it as a risk. And now the question is, how is it going to play out, right? So I think people have been very focused, obviously, on China. They had been focused a few months ago on Europe, and as the president had been talking about putting potentially tariffs on cars coming over from Korea and Japan and Europe, that would have a staggering impact on the economy. Now the president has kicked the can down the road for 6 months on that topic. But nobody expected using tariff policy as a way to impact immigration policy. And now, frankly, at the same time, while we're trying to renegotiate NAFTA for the USMCA, putting tariffs on in Mexico, you know, how do you think about supply chain management? Joele and I worked with a company recently where 90-ish% of their business is domestic, but a large portion of their cost of goods sold comes from Asia. How do they think about the level of tariffs, and how do they think about long-term supply chain planning? It's extraordinarily interesting.
Is that L Brands?
I don't know which one it is, but
Joele, on that question of bridging the gap, the sort of the understanding gap between DC and Wall Street, you obviously spend a ton of time with a lot of these bigger companies that do this kind of work and do these kind of deals where they are having to deal with, you know, whether it's Samra, whether it's CFIUS, or indeed the European equivalents. are they doing enough work to actually understand this before going out and pulling the trigger on deals?
I think the companies and the people that they have working with them are extraordinarily involved in doing it. What they can't do is predict the unpredictability of what the environment has been.
And fundamentally, CFIUS is an unpredictable process that has an opacity that is very difficult to navigate from the outside and is frankly changing.
It's in, I mean, CFIUS is in flux. We don't know how, you can't predict it at the moment. I think the antitrust world for some of the companies is in flux as well. And so I do think the companies have done their homework. I do think the bankers and the lawyers are doing their homework. But once you've announced, the world has this period of time, 6 to 9 months is a short end, and 9 to 18 to 2 years on the longer end. A lot can happen in that time period that's unpredictable, or you couldn't do it, and so PR is very important, guys.
Mark, comment on this. As Joelle said, we have all these unprecedented events. We've had Delaware rule on its first MAC, or at least go all the way to the floor on a MAC. We obviously had AT&T Time Warner, which was fairly unexpected. We had Broadcom Qualcomm, which was fairly unexpected, although you all agree CFIUS is unpredictable. How do you prepare clients for that when they're going and doing a deal, even a small deal, because you just don't know how the chips are going to fall?
I think what we've seen in cases that are notionally close to the line, there's a lot of, even before the companies engage in valuation discussions or how to put companies together. We've had a number of situations where they decided to do, if it's antitrust, to do the antitrust work on the front end to see if they actually both sides can agree that there is a path to approval. CFIUS, as Stefan said, is just much harder to predict. But I mean, obviously, in light of Broadcom, I mean, there's a tremendous amount of scrutiny around that. Look, the best advice to clients is, we've said, is, under the previous administration, you sort of had a box from an antitrust perspective. If you were in it, you could probably get it done. If you were out of it, you couldn't. The problem is, with this administration, it's very hard to define what that box is. Now we'll see, in light of the decision around Time Warner, what happens, and the desire for structural changes, not behavioral type stuff. But I think that you got to do the work up front. If you don't, you're potentially heading for danger because of the time frames. Not a lot of these deals ultimately don't. When we looked at the data, a lot of them eventually get done by hook or by crook, particularly on the antitrust side, if it's not just blatantly offensive. But the time frames are what really get people nervous. You couldn't get a semiconductor. A year ago, no semiconductor deals were getting done. Nobody would touch them because you didn't want to go to China. You didn't want to go to, at that point, it was MOFCOM. And now we've just seen 2 in the last couple of weeks in light of what is arguably a worsening China trade environment. So go figure.
I don't know that it's arguably. It's definitively.
But I think from several years ago, the way we work with clients has changed kind of in 3 parts, right? One, I agree with Mark, is there's a lot more pre-work before saying, do I pursue this or not? Then even for outside of the lawyer's work, from bankers' perspective, how you think about valuation is if you had to have this outcome on antitrust, that outcome on antitrust, if a deal closes in 12 months, 24 months, if you announce the deal and it doesn't close. So board has to be much more informed on a more nuanced way in terms of a range of outcomes. And I'd say the third piece that has changed is how do you do risk mitigation in all of these cases? Because you have to make sure that you protect the franchise. So whether that is finding a way to hold your people together, because again, historically, what would happen is people would have a higher degree of certainty that the deal would happen. So companies sold, everybody's out with their resumes on the market. So you don't want to have that because the deal may not close or it may take a long time. And how do you hold the company together? So more simplistic solutions which worked previously, buyer takes all the risk, or we have a huge break fee. Those things no longer are the solution because sometimes that may not be enough.
Valuation is fundamentally around financial projections, of course. And I guess what I would argue is the ability for companies, certainly in certain industries, to accurately put together a set of financial projections is going to be more challenging than it has been at any time in the recent past. And as a result of that, one might argue if valuation is fundamentally going to be harder, that is going to have a knock-on impact on activity, at least in the near term, until there is more clarity around that.
Yeah, and many of these things can also become circular, right? Because you say, okay, if there is, even if you look at tariffs, that's very complicated. It's not a one-line adjustment to anybody's
It's
model.
also fluid.
Yeah.
Changes every day.
But what's interesting is that even though valuations in the last quarter are down a little bit, we're still trading at about 0.7 EBITDA multiples, and it was higher. So, while we talk a lot about we're going to handle this from a valuation perspective, it's not clear to me that the data necessarily supports that people are actually doing that. Now, obviously, it's a law of large numbers, so it could very well be the case. But you're still in a valuation environment that's still pretty high.
But one might also argue that we're in the early innings, $10.
$10.
We can sort it out later.
of understanding what these impacts are actually going to be to the larger economy. So you talked about confidence. Consumer confidence is still relatively high, but consumer confidence is not really what's driving board decisions. And as some of these impacts get more largely diffused into the economy and purchasing power goes down, the New York Federal Reserve has suggested that roughly a family income is going to go down by $830 some odd, that confidence is going to go down, and you could imagine the equity markets responding accordingly, which could be at least why there's some dissonance between the credit markets and the equity markets on this topic at the moment.
So the financing environment still helps, right? Particularly in the investment grade market. It's
very
big,
aggressive.
It's aggressive, and so that to some extent in a market that's, as Anu was saying, sort of 70% cash deals, it's a factor.
Let's talk about leaks. Who wants to answer a question about leaks? Why they happen, primarily?
Okay, this is mine, guys. We decided it ahead of time. I mean, we talked about it, and
Well, no banker wants to be the first
no,
to
we're
talk
talking
about
about
leaks.
it. Right. And we're talking to the reporter who actually knows who's leaked to him, so it's kind of unique. But what we've come up with is, take your hand, okay, kill a deal, check a price, ego, notice the finger, stupidity, and luck. And so that's the way we've always sort of, when I explain it to a client, they say, well, why do deals leak? And I say, well, But this seems to cover and the first one where it's kill a deal, it's also retribution if there was an auction and somebody's annoyed. We don't really know, but Ed knows. We can ask Ed. Ed, why do deals leak to you?
I perhaps know how leaks arrive with us, but I don't necessarily know the motivation, nor care sometimes, because if the information is good, whether someone leaked it because they were stupid or had an ego is immaterial. Is it ever helpful, though? You talk about a price check. I guess in some cases that does happen.
Historically, in Europe, the price checks were pretty major. But these days, I just had a leak occur within 2 or 3 hours of someone announcing, and it killed the deal totally because people didn't understand, whoever leaked did not understand the Irish takeover rules. So the deal died, because they couldn't get it, they didn't have enough time to get through the machinations of how it would work.
Was it Aon?
Yes.
Oh, sorry.
Yeah.
I actually don't think it is helpful at all. So I don't know, others may have a different view, but I don't think it's helpful to have a leak. It's very frustrating when that happens. Maybe it's good for you, but certainly not good for us. Joel talked earlier about how important it is in staying on step with your shareholders and getting the communication of the deal right. That's very important. It's not guaranteed that you announce something and it'll close. It's not guaranteed that when you announce something, people understand it. Enormous amount of effort and time and energy goes into preparing to announce it the way you want to announce it. There's a lot of stakeholders. There's the employees in the company, there's the customers, there's the suppliers, there's the shareholders. And so to take all of that, have all of that ripped away from you and have a leak is extremely unhelpful.
When a leak occurs, not being able to get to your shareholders with the full story, with the entire panoply of what you've got available. You only have a certain number of arrows in your quiver with which to do this. And so if your hands are tied behind your back because it's not done, or the information, you haven't been able to talk to everybody to get it settled, and the materials aren't done or aren't approved, and you've got two sides, nothing's worse than a friendly deal. You've got to be nice to everybody. So everybody's, you're in each other's way, and if a leak occurs, it's hard.
It's
I know, merger of equals.
Yeah, really.
Particularly problematic in rules-based systems like the UK and Ireland, because it completely changes the nature of the game. Look, it's not surprising to me. We look at the plethora of media sources. Back in the Stone Age when I started, it was basically the Journal, the Times, the FT, then CNBC and Bloomberg, And now, with all the social media, there are just a ton of sources, and people are banging on doors, and it's just not that surprising. But I mean, it's a sort of, you got to plan for it. It's just a fact of life.
Around the question of, and this relates to leaking, but around the question of spin and narrative on deals, which obviously is, you will say, is becoming much more important. Because everyone now has a platform, or potentially has a platform, every shareholder can go on Twitter, or a lot of shareholders can go on CNBC or indeed Bloomberg and talk about their views on a particular deal or aspect of a deal. How do you manage that through a process? Because I think of a recent deal, which a few of you here were involved in, which was the Oxy Anadarko Chevron deal. And without going into any specifics on it, the spin around that was probably more aggressive than any deal I've dealt with since Valley and Allergan, where there was obvious good reason for the spin. Is that now like a core component of any big complicated transaction, particularly if there's hostility involved, that you just have to be out engaging with the media all the time, engaging with shareholders all the time, and really winning the narrative war as much as the kind of making the economic case?
But don't you think that one's unique because it was an auction, supposedly an auction silently, that went into the public domain after the announcement? So if you have that, that's my favorite thing in the whole world. If you have that, then you do have each side, it's a political campaign. Which side has a better platform?
I think that's exactly the right analogy. And it goes back to your other question about the franchising or enfranchising of shareholders that you mentioned earlier. And in order to get the vote in a political campaign, you actually go through that sort of thinking and that sort of process.
Between bumperage from the activist, bumperage is when the activists come in, and lately a whole mess of their programs have been to get a higher price, or it wasn't enough, or you should sell to somebody else, and did you think about this or that? And it's been major to deal with it. It's been a new factor in a lot of the M&A that's come up.
It very much correlates, as Stefan's saying, you look at the votes from some of the active managers now against management. They've gone up dramatically. And if you don't get out there and get your story out into the media and then ultimately to the shareholder base, you're doing yourself a real disservice, because the other side will. So it's a little bit of, you're building up arms on both sides. I don't think it's going away. I think if anything, it's going to get worse.
This is a good note on which to end, the world in which people talk to the media more. I like that. Guys, thank you so much for joining.
Pleasure.